Something shifted overnight in the precious metals market. If you've been watching silver, you noticed it. A sharp drop, sudden, dramatic. And the immediate question becomes, what does this mean? Before we go further, let me be clear about what this video is not. This is not hype. This is not a prediction. And this is certainly not a call to panic or to act rashly. What this is an analysis. A calm, measured look at what just happened, why it matters, and what it means for anyone who holds silver or has been considering it. You're here because you want to understand, not react, not chase noise. Understand, and that's exactly what we're going to do together. The overnight movement in silver wasn't just a price fluctuation. It was a signal, a data point in a much larger pattern that's been building for months, if not years. And if you've been paying attention to debt levels, currency markets, and the behavior of central banks, you already know that we're not in normal times. This video is for two groups of people. First, those who already hold silver and need clarity about what's happening and what it means for their position. Second, those who don't hold it yet but have been watching, learning, and trying to understand if and when it makes sense for them. By the end of this, you'll understand the macroeconomic forces at play, the historical context, and most importantly, how to think about this moment without letting emotion drive your decisions. Let's begin. Let's start with the facts. Silver dropped sharply overnight, approximately $2 per ounce in a very short window. For those unfamiliar with precious metals volatility, this might seem shocking. For those who've watched these markets for years, it's familiar terrain. But here's what makes this moment different. The drop didn't happen in isolation. It happened alongside unusual activity in futures markets, increased short positioning by commercial banks, and commentary from financial institutions that have historically been skeptical of precious metals as an asset class. When you see coordinated movement like this, you have to ask yourself, what changed? Was it new information about supply and demand? Was it a shift in investor sentiment? Or was it something else entirely? The truth is, physical silver fundamentals haven't weakened. Industrial demand remains strong. Supply constraints continue. Green energy technologies still require significant silver input. Solar panels, electric vehicles, 5G infrastructure. None of that changed overnight. So if the fundamentals haven't shifted, what has? The answer lies not in silver itself, but in the broader financial system. And that's where things get interesting. Let's talk about banks, not in abstract terms, but in concrete ones. Banks are exposed to precious metals markets in multiple ways. They hold positions, they facilitate trading, they manage risk, and right now they're under pressure. Why? Because the financial system is experiencing stress that most people don't fully see yet. Interest rates have been elevated for an extended period. That creates problems for institutions holding long-dated bonds. It creates challenges for debt rollover, and it makes certain hedging strategies more expensive. When banks are under pressure, they often reduce exposure to assets they consider volatile. Precious metals fall into that category. But here's the paradox. The very conditions that make banks want to reduce precious metals exposure are often the conditions that make those metals more valuable long-term. Think about it. And what creates pressure on banks? Debt problems, currency instability, concerns about systemic risk, and what historically performs well during those exact conditions? Hard assets, tangible stores of value, things that can't be printed or created by policy decisions. This is not conspiracy theory. This is market mechanics. Banks operate on leverage. When that leverage becomes risky, they make adjustments. Sometimes those adjustments create short-term price movements that don't reflect underlying value. The question you need to ask is this: does the overnight drop in silver price represent a change in silver's fundamental value? Or does it represent institutional positioning in response to their own balance sheet pressures? Most investors miss this distinction entirely. They see price movement and assume it must reflect new information about the asset itself. But often, especially in heavily traded markets like precious metals, price movements reflect the positioning needs of large players more than changes in fundamental value. Let's zoom out, way out, because you can't understand what's happening in silver without understanding what's happening in the global financial system. We're living through a period of unprecedented monetary experiment. Central banks expanded their balance sheets dramatically over the past 15 years. They kept interest rates artificially low for over a decade. They supported asset prices through direct intervention. And now they're trying to unwind those policies without breaking anything important. It's not going smoothly. Inflation proved more persistent than anticipated. Rate hikes were more aggressive than many expected. And the side effects are showing up in ways that aren't always obvious to casual observers. Banks that loaded up on low-yield government bonds during the zero-rate era are now sitting on unrealized losses. Countries with high debt-to-GDP ratios are facing dramatically higher interest costs. Emerging markets that borrowed in dollars are struggling with currency weakness and debt service. None of this is hypothetical. This is happening right now, and it creates a specific environment for precious metals. Here's the dynamic. When financial stress builds, markets initially sell everything liquid. They need cash, they need to meet margin calls, they need to reduce leverage. That includes precious metals, so you get short-term price drops. But then, as the stress continues and people realize the underlying problems haven't been solved, capital flows back toward hard assets, toward things that preserve value, toward stores of wealth that exist outside the banking system. This pattern has played out repeatedly throughout history. 2008 saw it, 2020 saw it, and we may be seeing it again. The overnight silver drop fits perfectly into the first phase of this pattern. Liquidation, positioning, risk reduction. But if the macro stress continues, which many indicators suggest it will, the second phase becomes more likely. Most people fundamentally misunderstand how precious metals markets work. They think of gold and silver as pure supply and demand commodities. But they're much more than that. They're monetary metals, they're crisis hedges, they're portfolio insurance. And like all insurance, they don't pay off continuously. They pay off during specific conditions that increasingly look like what we're experiencing now. The misunderstanding creates opportunity for those who see it clearly. When price drops, casual observers think the thesis is broken. They think something must have changed. They react emotionally. Experienced investors do the opposite. They ask, has anything actually changed in the fundamental case? Are the conditions that made this asset attractive still in place? And if the price has dropped while the conditions remain, has the risk-reward improved? This is critical. Price and value are not the same thing. Price is what you pay. Value is what you get. And sometimes, temporary price dislocations create opportunities to acquire value at a discount. Right now, the fundamental case for precious metals exposure hasn't weakened. Government debt continues to expand. Central banks continue to face impossible trade-offs between inflation and growth. Currency instability continues to simmer. The conditions that historically favor hard assets remain firmly in place. And what's changed is price. And that's worth noting carefully. Another thing most people misunderstand is timing. They want to buy at the exact bottom and sell at the exact top. But that's not how successful investing works. Successful investing is about probabilities over time. It's about position sizing. It's about understanding cycles and maintaining exposure to assets that protect purchasing power over the long term. The overnight drop in silver doesn't invalidate the long-term case any more than a single sunny day invalidates the concept of winter. What matters is the overall pattern, the direction of the wind, the accumulation of pressures that point toward a specific outcome. Let's look backward for a moment, because history doesn't repeat, but it certainly rhymes. In the early 1970s, the gold standard ended. Currency became fully fiat. And over the following decade, precious metals went on a historic run as inflation ravaged purchasing power and trust in paper currency eroded. That run didn't happen overnight. It happened in waves: advance, pullback, advance, pullback. Each time prices consolidated or dropped, some investors lost faith. They sold, they moved on, and they missed the major move that followed. The 2000s saw a similar pattern. After decades of sideways action, gold and silver began multi-year bull markets. But those markets were interrupted repeatedly by sharp corrections. 2008 saw dramatic short-term drops as everything liquid got sold. But then, as the reality of the financial crisis set in, precious metals resumed their advance. In 2020, during the early pandemic chaos, gold and silver both dropped sharply in March as markets seized up. 3 months later, silver hit multi-year highs. The pattern is consistent. During periods of financial stress, the initial reaction is liquidation. Everything gets sold. But as the stress persists and solutions prove elusive, capital flows back toward assets that protect against currency debasement and systemic risk. We may be in the early stages of another such cycle. The overnight drop in silver could be the liquidation phase. The question is, will the underlying stresses persist and intensify? If they do, history suggests what comes next. But here's what I want to emphasize. History provides context, not certainty. The fact that precious metals rebounded after previous drops doesn't guarantee they'll do it again. What it does is provide a framework for understanding probability. And right now, the probability framework looks interesting for anyone who understands macroeconomic cycles. If you already hold silver, you're probably feeling something right now. Maybe concern, maybe doubt. Maybe you're wondering if you made a mistake. Let me address that directly. First, if you bought silver as a long-term store of value, nothing about the overnight drop changes that thesis. You didn't buy it for next week's price. You bought it because you understand monetary history and you wanted protection against scenarios that paper assets can't hedge. Short-term volatility is the cost of admission. It's not a flaw in your strategy. It's a feature of the asset class. Precious metals are volatile. They always have been. If you expected smooth, steady appreciation, you misunderstood what you bought. Second, this is a moment to assess your conviction, not your emotions, your conviction. Do you still believe the fundamental case is intact? Do you still think debt levels are unsustainable? Do you still see currency risk ahead? If yes, then temporary price movement shouldn't shake you. Third, consider your position size. If the overnight drop is causing you significant stress, you might be overexposed. The right position size is one that lets you sleep at night even when prices are volatile. If you can't handle a $2 drop without anxiety, you probably own too much. But if you sized your position appropriately and you understand the macro picture, this should feel like noise. Uncomfortable noise, perhaps, but noise nonetheless. What you should not do is make emotional decisions. Don't sell in panic. Don't convince yourself the thesis is broken just because price moved against you. And definitely don't start following online commentary from people who are trying to tell you minute by minute what to do. Instead, do this. Review your original reasoning. Look at the conditions that led you to buy. Ask yourself honestly if those conditions have changed. And if they haven't, maintain your position and wait. Patience is not passive. Patience is active discipline. It's the willingness to endure discomfort because you understand that meaningful outcomes take time. If you don't currently hold silver, but you've been watching, learning, and considering it, this moment raises important questions. Should you buy? Should you wait? Should you do nothing? Let me give you a framework, not advice, because I can't tell you what to do with your money, but I can help you think more clearly about the decision. First, understand why you'd even consider silver. If it's because you think it's going to make you rich quickly, stop. That's the wrong reason. Silver is volatile, speculative, and unpredictable in the short term. If you're looking for get rich quick, you're in the wrong asset class. But if you're considering it as portfolio diversification, as a hedge against monetary instability, as protection against scenarios where paper currencies lose purchasing power, then the conversation is different. From that perspective, the overnight drop might actually be interesting. Not because you're trying to catch a falling knife, but because if the fundamental case remains intact and the price has dropped, the risk reward may have improved. Here's what matters. Silver should never be your entire portfolio. It shouldn't even be a dominant part. It should be the insurance component, the asymmetric hedge, the position that protects you if certain scenarios unfold. Most prudent investors allocate somewhere between 5 and 15% of their portfolio to hard assets, including precious metals, not because they expect those assets to outperform every year, but because they understand that diversification means owning things that perform differently under different conditions. If you decide to establish a position, do it gradually. Don't try to time the bottom. Don't go all in because price dropped. Average and over time. Build your position methodically and maintain it as long as the conditions that justify it remain in place. Also, educate yourself continuously. Understand the difference between paper silver and physical silver. Understand storage and security. Understand the tax implications. Understand the spread between buy and sell prices. These practical details matter enormously. And here's something almost no one talks about: the mental game. If you're going to hold precious metals, you need to be psychologically prepared for volatility. You need to be able to watch your position move against you without panic. You need to understand that this is a long-term position, not a trading vehicle. If you can't handle that, don't buy. Seriously. It's better to miss a potential opportunity than to buy something that will stress you out and cause you to make emotional decisions. Let's talk about mistakes. Because in moments like this, when markets are volatile and information is flying around, people make predictable errors. Let's make sure you don't. First, don't make decisions based on single data points. One overnight drop doesn't tell you anything definitive. It's information, but it's not the whole picture. Wait, watch. Assess patterns over time. Second, don't listen to people screaming about emergency action. Anyone telling you that you must buy right now or you must sell right now is not giving you analysis. They're giving you pressure. Real analysis is calm. It considers multiple scenarios. It acknowledges uncertainty. Third, don't leverage. This is critical. Some people get excited about volatile assets and think they can magnify gains through leverage. Maybe they buy on margin. Maybe they use options. Maybe they use leveraged products. Don't. Volatility and leverage are a dangerous combination. It's how people get wiped out. Fourth, don't forget about liquidity. If you put money into precious metals that you might need in the next 6 months, you're making a mistake. Hard assets are long-term positions. You need to be able to hold them through volatile periods without being forced to sell at the wrong time. Fifth, don't ignore the rest of your portfolio. Some people get so focused on precious metals that they neglect diversification. They put too much in one place. They forget about emergency funds. They forget about cash flow. Don't do this. Hard assets are one component of a complete financial strategy, not the entire strategy. Sixth, don't follow social media hype blindly. There are people online who build their entire brand around pumping precious metals. They post constantly about how this is the moment, this is the big move, everything's about to change. Maybe they're right, maybe they're not. But following them emotionally is not a strategy. Seventh, Don't confuse activity with progress. Sometimes the best move is no move. Sometimes sitting still, staying informed, and maintaining discipline is exactly what the situation requires. Not every market movement demands a response. And finally, don't convince yourself you have to be all in or all out. You can hold a position. You can be neutral. You can observe. You don't need perfect conviction to maintain a diversified portfolio. You just need reasonable probability and appropriate position sizing. Let's step back one more time and look at what's really happening here. Because the overnight silver drop is just one symptom of a much larger dynamic. We're watching a global financial system that's been stretched to its limits try to normalize. That process is messy. It creates volatility. It creates uncertainty. And it creates both risks and opportunities. Central banks are caught in an impossible position. If they keep rates high, they risk recession and debt problems. If they lower rates, they risk reigniting inflation. There's no clean solution, only trade-offs. Governments are facing debt burdens that, historically, have only been resolved through growth, default, or inflation. Growth seems unlikely at the scale needed. Default is politically unthinkable, which leaves inflation, maybe not immediately, maybe not all at once, but as a gradual erosion of purchasing power over time. This is the environment we're in, and in this environment, having some exposure to hard assets makes sense for many investors, not because it's guaranteed to work, but because the probability framework justifies it. The overnight drop in silver is noise within that broader context. It's market mechanics, it's institutional positioning, it's short-term volatility, but it doesn't change the fundamental reality that we're living through a period of monetary stress and currency uncertainty. What matters now is how you respond. Do you panic? Do you get emotional? Do you make decisions based on fear or greed? Or do you stay disciplined, stay informed, and maintain positions that make sense for your long-term goals? Let's talk about what's happening in your mind right now, because that matters more than anything else. If you hold silver and you're feeling anxious about the drop, that's normal. Loss aversion is a powerful psychological force. Studies show that losses feel roughly twice as painful as equivalent gains feel good. Your brain is wired to react strongly to losing value. But here's what experienced investors understand. Temporary price movements are not the same as permanent losses. You only actually lose if you sell. Until then, it's just mark-to-market volatility. The psychological challenge is maintaining conviction when prices move against you. That's hard. It requires you to separate emotion from analysis. It requires you to trust your original reasoning, even when market behavior suggests you might be wrong. Here's a mental model that helps. Think of investing in cycles, not in straight lines. Every asset class goes through periods of favor and disfavor. Sometimes your positions perform well, sometimes they don't. What matters is maintaining appropriate exposure across complete cycles. If you bought silver because you understood the macro case and wanted long-term protection, then short-term price drops should actually strengthen your conviction. Because the conditions that made you buy are still in place, but now the price is lower. But if you bought silver because you thought it was going to go straight up, you misunderstood the asset. Nothing goes straight up. Everything experiences volatility, accepting that reality is part of being an investor. Another psychological trap is recency bias. We tend to give too much weight to recent events. The overnight drop feels significant because it just happened. But zoom out. Look at the 5-year chart. Look at the 10-year chart. One night of movement is almost invisible in that context. Train yourself to think in time frames. What does this mean for the next week? Probably nothing definitive. What does it mean for the next year? Maybe something. What does it mean for the next decade? That's where the real question lies. Let's get practical about risk, because understanding risk is what separates investors who survive from investors who don't. First principle, never risk more than you can afford to lose. That sounds obvious, but people violate it constantly. They put rent money into speculative assets. They leverage their investments. They convince themselves that this time is different. If you're holding precious metals, make sure it's money you don't need for years. Make sure it's positioned as long-term savings, not short-term trading capital, because that's the only way you'll be able to hold through volatility without panic. Second principle, diversification protects you from being wrong. Maybe precious metals don't perform as expected. Maybe the monetary stress resolves differently than anticipated. If you're diversified, that's okay. You have other positions that can perform. Don't put all your eggs in one basket, not in silver, not in stocks, not in real estate, not in any single asset. Spread your risk across multiple categories so that no single outcome determines your financial future. Third principle, position sizing matters more than timing. People obsess over whether to buy today or wait until tomorrow. That's mostly noise. What actually matters is how much you allocate. If you're right about the macro picture but you sized your position too small, you don't benefit much. If you're wrong and you size too large, you suffer unnecessarily. Find the middle ground. Allocate enough to matter if you're right, but not so much that it devastates you if you're wrong. Fourth principle, have an exit strategy, but don't be trigger happy. Know under what conditions you would sell. Maybe it's when the macro picture fundamentally changes. Maybe it's when you need the capital for something else. Maybe it's when your portfolio rebalancing requires it. But don't exit just because of short-term price movement. That's not a strategy. That's emotional reaction. Your exit criteria should be based on fundamental changes, not daily volatility. So what happens next? Where do we go from here? These are the questions everyone wants answered. And the honest truth is, nobody knows for certain. Right, what we can do is assess probabilities. We can look at historical patterns. We can understand the forces in motion. And we can make informed decisions based on that understanding. Here's what we know. Global debt levels remain at historic highs. Central banks remain in a difficult position. Inflation is moderated, but hasn't disappeared. Currency stress continues in various regions. Industrial demand for silver remains strong. Supply remains constrained. Those are facts. They create a specific probability framework for precious metals over the medium to long term, not certainty, probability. The overnight drop might be the beginning of a larger correction, or it might be a temporary shakeout before another leg higher, or it might be sideways consolidation for an extended period. All three scenarios are possible. What matters is not predicting which will happen. What matters is being positioned appropriately for multiple scenarios. If you have a well-sized position in precious metals as part of a diversified portfolio, you're fine regardless. If silver drops further, you haven't overallocated, so it doesn't devastate you. If silver rallies from here, you have exposure, so you participate. If it goes sideways, you're patient because you understood from the beginning that this is long-term capital. This is how sophisticated investors think. They don't try to predict. They position for probability across multiple outcomes. They manage risk. They stay flexible. And they avoid emotional decisions. Looking ahead, watch these signals. Central bank policy shifts, government debt trajectories, inflation data, currency stress indicators, physical demand versus paper market positioning. These tell you more than daily price movements. Let's return to the question we started with. Why are banks suddenly desperate? What's really happening behind the scenes? Banks operate on thin capital margins. They use leverage. They manage complex positions across multiple markets. And right now, many of them are under pressure that isn't always visible to the public. Commercial banks have been net short silver for years. That means they've taken positions betting against rising prices. That's not conspiracy. That's documented positioning you can find in commitment of traders' reports. When prices move against those positions, banks face margin calls. They face pressure to cover or add to positions, and they face decisions about whether to maintain those positions or exit them. The overnight drop in silver could easily be related to institutional positioning needs rather than fundamental changes in supply and demand. Large players moving in and out of positions can create significant price movement, especially in relatively smaller markets like silver. What does this mean for you? It means you need to distinguish between price action and value. Just because price moved doesn't mean value changed. Understanding this distinction is critical. Banks may be desperate because they're managing balance sheet stress, managing positions gone wrong, or responding to regulatory pressure. None of that changes the fundamental case for holding some precious metals exposure as part of a long-term strategy. In fact, if banks are under the kind of pressure that forces them to aggressively manage precious metals positions, that might actually validate the macro concerns that make precious metals attractive in the first place. Think about it. Financial stress in the banking system is exactly the scenario that hard assets are meant to hedge against. So if the price drop is related to banking stress, that's not a sign to abandon the position. It's a sign to pay attention to the bigger picture. So where does this leave you? What should you do now? How do you navigate this moment intelligently? First, take a breath. Seriously. Step away from the minute-by-minute price movement. Stop checking quotes constantly. Give yourself psychological space to think clearly. Second, review your situation. Look at your overall portfolio. Look at your allocation to hard assets. Ask yourself honestly if it's appropriate given your goals, your timeline, and your risk tolerance. If you're overexposed, consider reducing gradually. Not in panic, not all at once, but methodically over time until you reach a position size that lets you sleep at night. If you're underexposed and you believe the macro case remains valid, consider building a position gradually, dollar cost average over weeks or months. Don't try to time the bottom, just establish exposure at a size that makes sense. If you're appropriately positioned, do nothing. Maintain discipline. Ignore the noise. Stay informed about macro developments. But don't react to every price movement. Third, educate yourself continuously. Read about monetary history. Study past cycles. Understand how markets behave during financial stress. The more you understand, the less emotional you'll be. Fourth, maintain perspective. Your portfolio is not your net worth. Your net worth is not your identity. These are financial tools designed to help you build long-term wealth and security. Don't let short-term volatility affect your well-being or your relationships. Fifth, stay flexible. Conditions change. Information evolves. Be willing to update your views if facts change, but don't confuse updating your views with reacting emotionally to price movement. The path forward is not complicated. It's just hard. It requires discipline. It requires patience. It requires the ability to tolerate uncertainty without panic. Those are skills you can develop, and they're more valuable than any investment return. We've covered a lot in this discussion. Let's bring it together. An overnight silver drop happened. It was significant in percentage terms. It raised questions, and it created emotional responses in investors who hold the metal or are considering it. But when you zoom out and look at the macro picture, this is just one data point in a much larger story. A story about debt, currency, inflation, and the ongoing challenge of managing a global financial system under stress. The fundamental case for holding some hard assets as part of a diversified portfolio hasn't changed. Governments still have massive debts. Central banks still face impossible trade-offs. Currency instability still simmers beneath the surface. These conditions historically favor tangible stores of value. The overnight drop doesn't invalidate that thesis. It might actually validate it if the drop is related to banking stress and institutional positioning needs. Time will tell. What matters now is how you respond. Not what you predict, not what you hope for, but how you actually manage your portfolio and your psychology through uncertain times. The best investors aren't the ones who predict the future. They're the ones who position themselves appropriately for multiple futures. They're the ones who manage risk. They're the ones who stay disciplined when everyone else is panicking. You can be that investor, not by being smarter than everyone else, not by having secret information, but by understanding basic principles, by maintaining appropriate diversification, by sizing positions correctly, and by refusing to make emotional decisions. Here's what I want you to take away from this discussion. 1. Short-term price movements are noise within long-term cycles. Don't confuse the two. 2. The macro conditions that historically favor hard assets remain in place. High debt, currency stress, central bank pressure, these are facts, not speculation. 3. Your response matters more than the market's action. Stay disciplined, stay diversified, stay educated. 4. There's no need to panic and no need to rush. Whether you hold silver or you're considering it, make decisions from a place of calm analysis, not emotional reaction. 5. Risk management trumps prediction. You don't need to know what will happen next. You just need to be positioned appropriately for multiple scenarios. The crisis that some analysts have been warning about may or may not be here. What is definitely here is a moment that requires thoughtful decision-making. A moment that separates investors who understand cycles from those who react to noise. My goal today wasn't to tell you what to do. It was to help you think more clearly about what's happening and what it might mean. Because clear thinking is the most valuable skill any investor can develop. Markets will continue to be volatile. Prices will move. News will flow. And people will panic. That's inevitable. What's not inevitable is whether you panic with them. You have a choice. You can be reactive or you can be thoughtful. You can chase headlines or you can understand cycles. You can make emotional decisions or you can maintain discipline. Choose discipline. Choose education. Choose patience. Not because they guarantee success, but because they maximize your probability of success over time. Thank you for watching. Stay informed, stay balanced. And remember, the goal isn't to get rich quick. The goal is to preserve and grow wealth sustainably across complete cycles. If this video helped you think more clearly, consider subscribing for more in-depth analysis. And as always, do your own research. Talk to professionals. Make decisions that fit your specific situation. The financial landscape is changing. That's both challenge and opportunity. How you navigate it depends entirely on how well you understand what's happening and how disciplined you remain in the face of uncertainty. We'll keep watching, we'll keep analyzing, and we'll keep providing perspective when markets get volatile and emotions run high. Until next time, take care of yourself and your portfolio.